First of all, my apologies. I'm going to have to, losing my voice today. So I'm hoping, I'm hoping I can get through this. I have 20 minutes. I have 40 slides. It's going to be a little bit more of a challenge, I think. But on the other hand, it's going to be a little bit easier, I think, because I'm going to have to keep it short. Um, so, oh. So let me quickly go into the focus. So this is going to look a little bit at the CIS. Trying to find the right octave here to keep my voice so I can actually get something out. I don't want to go spend too much time on the hydrocarbon dependence, but you see the, I think everyone's quite familiar with the oil price slide. Just to basically show this is our sort of forecast is basically we're expecting the sustained low oil prices, now just the oil price environment. We are at a point at which we are not looking for anything, we're not expecting to see anything coming back in any increase back to the $80, much less $100 forecast. Quickly on the hydrocarbon dependence, you see basically in the CIS you have the 5 major producers here, all very highly dependent on oil and gas reserves or oil and gas revenues, both as in terms of GDP growth as well as for essentially budget revenues. Obviously, slightly less in Uzbekistan, but I think what we've seen in the last 2 years is really this sort of, or 3 years now, is kind of an approach towards treating the symptoms rather than the actual dealing with the hydrocarbon dependence. Governments were very slow in the region to respond. We've had basically, I would say, the January 2016 oil price collapse or oil price slide was kind of the prompting the governments to push the panic button in terms of actually moving towards more dramatic measures and policy responses towards a lower oil price environment. We saw in Russia and Kazakhstan draining the reserve funds, or drawing down at least, imposition of capital controls, and really a changed approach towards budget forecasts, revising the oil price budget assumptions dramatically down from 2016. I would say we've seen the crisis mentality has somewhat eased with the oil price recovery. But really, we have a question mark as to what happens if we have a further slide, and we have potentially still downside risks in the oil market and the price. I know there's a greater focus now on the likely or the future implosion of Venezuela, the questions with Iraq, and also the uncertainty with regards to the nuclear deal in Iran and the future in that sense. So we have some upside potential with oil price. But significantly, there's a question mark for some of these CIS producers about how they actually can, are they in a position to function if there's a further oil price slide. I'm going to just leave some of these here because I know we're short on time, but also I think you can see we've had deteriorating current account balances, we've had worsening balance sheets. I'm going to spend a little bit of time. Russia obviously is in situation. Hopefully these slides will be available. You can have a little bit more detail later on. I'll try to give you just a little bit of color. But Russia's obviously got a huge cushion. We've basically drawn down the reserve fund, and now we're reconsolidating that in with the National Welfare Fund. The cooperation with OPEC is obviously a question of trying to support an oil price recovery. This one thing we're looking at now is the potential that Russia would be creating some spare capacity for the future for itself. It's a very small amount, and there is a question about the operational aspects of being able to keep wells in Western Siberia functional during the wintertime if you're not producing. Clearly, now the table has basically been set for Putin to remain in power. It's kind of this kabuki theater aspect of whether or not we're actually going to have any opposition candidates, legitimate opposition candidates. I know we have the daughter of the former mayor of St. Petersburg, Ksenia Sobchak, who's a reality TV star basically in Russia. But I think we all sort of dismissed the idea of a reality TV star at our own peril as an election force. Quickly on sanctions in Ukraine, or sanctions, Ukraine-related sanctions. We have I would say, in the new U.S. sanctions that went into effect, or they're passed actually in August, signed into law by Trump. Basically, it was a veto-proof congressional passage of the legislation. Clearly, it limits Trump's ability to actually function with regard to Russia, which I think obviously is Congress basically showing that the president, they don't trust him in terms of foreign policy with Russia. We'll leave it at that. The new restrictions essentially widen this divergence, widen the divergence between the U.S. and the EU sanctions. And there is a question then in terms about the enforcement and the effectiveness of the sanctions. And one of the things we see with the new U.S. sanctions is this the imposition of secondary sanctions, the potential for imposition of secondary sanctions, which is discretionary rather than mandatory, which I think is an important aspect of whether or not we see the Trump administration actually go through to enforce some of these sanctions or to apply these on European companies engaging with Russia. Shifting to Kazakhstan, I think we've seen sort of a more two-phase approach. There's very much in the first year, we had a very prudent response in some ways in terms of a very low oil price assumption. Basically also had a devaluation of the tenge. We have seen an improvement over the last year, but I think we look back and say the response to the Zhanaozen oil riots in 2011 is basically, or the impact of that has resonated with government policy over the last several years in terms of the government's unwillingness, A, to tolerate protests to begin with, and B, to actually address some of the socioeconomic conditions that are causing these to happen in the first place. And I think this is where we've seen a desire to avoid this kind of approach. So we actually put a moratorium on land reform, or the land sales previously, addressing some of the labor strikes that we've had by actually addressing some of the issues that the strikers are actually are protesting about. And then last year, the retroactive mineral extraction tax relief for Uzun Munagas, which was the production unit subsidiary of KMGEP, that was the site of the oil riots from 2011. And they're basically laid to the government down I would say almost an ultimatum saying, if you do not give us tax relief, we're going to have to lay off workers. And we all know how that went last time. I think we've had in Kazakhstan essentially the last 18 months essentially, or 15 months, the FID in the Tengiz Chevroil project, obviously a huge $36.8 billion investment decision, creating new jobs, but also giving sort of the expectation of reinvigorating what we see as production growth coming from Kazakhstan, and the successful restart of the Kashagan field in October of last year. Clearly, we have the outlook is much improved in Kazakhstan as a result. We have new subsoil and tax codes that were expected to come into effect from the beginning of the year in 2018, essentially geared towards attracting more foreign investment, particularly in the offshore, but in some of the onshore projects as well, and moving beyond a little bit of sort of what Kazakhstan has kind of become sort of three big projects, and I think the government is really keen to see some of the smaller projects actually succeed as well. The succession question is an ever-present issue. I think Nazarbayev has moved to try to address this, but constitutionally, his daughter is still not in the line of power. I've talked with my colleagues, and I've basically said the expectation is that as his health deteriorates, that he'll move her into a position where she's actually constitutionally in line for power. There's a question mark, I think, in that sense. If we look at various scenarios of what happens if Nazarbayev dies tomorrow. He's 77 years old as it is. There is a question mark, and I think there is a desire from the investor standpoint to see stability. But one would argue you're not actually supposed to know the next president before this president is out of office. Azerbaijan, I think we can see sort of the last 3 years have been very detrimental to the government in terms of the dependence. Again, 75% dependent on hydrocarbons basically, and 75% of that, 75% of the oil comes from the same project. government, because of parliamentary elections in November 2015, did not cut back on spending. We had a $90 barrel oil price budget assumption for 2015, which, if you recall, was not $90 in the actual time. So we drew down significantly on the state oil fund during that year. You see on the charts here, we have seen some recovery in this year, but we had the Nagorno-Karabakh frozen conflict unfrozen again, and yet in some ways we've actually managed to put the genie back in the bottle here in the last year and a half. There is a question about this as a sort of existential threat in the overall sense to Azerbaijani oil and gas infrastructure. And again, any kind of retaliation by the Azeri government would actually have much more negative ramifications or repercussions for its own investors, BP in particular. I think there's a question mark about BP's ongoing investments in Azerbaijan if this were to be the case. And I think this is why everyone is very much interested in making sure Nagorno-Karabakh does not become unfrozen once again. I think we have seen, though, as we've seen AIOC, you see the declining trend in oil production from the ACG fields. There is a question about whether or not we would expect to see some at least stabilization, if not some slight increase, now that we have a deal to extend the contract to 2049. Contract of the century basically been superseded by an amended and restated contract. The signature bonus paid to SOFAZ over an 8-year period is important in the money itself, but also in the structure. 8 years and 8 tranches. Essentially means that there's going to be a steady flow of revenue to SOFAZ rather than one big lump sum, which would have the ripe for abuse. But I think we also see now there's a question mark of SOCAR increasing its stake from 11.6 to 25%. There is a question about how the state how SOCAR or the Azeri government is actually going to finance that, and if we're just going to be reusing that money from the signature bonus from SOFAZ then to actually fund SOCAR's costs in the expansion or in future investments. And obviously we're trying to bridge the gap here to the Shah Deniz Phase 2 project coming on stream, or beginning gas exports in the Phase 2 part from the end of next year. Turkmenistan, I'm not going to spend too much time on this. I'm happy to talk separately, but I think the question most investors would look at Turkmenistan is we have the questions on the official data. There's plenty of I would say there's plenty of resources. There's not so many opportunities. Clearly, a heavy dependence on China, increasingly oops, I think I took one slide out here. We have essentially a question mark in terms of the diversification of gas exports. We've shifted from one hegemon to another now, from Russia to China, and almost exclusively dependent on China as a buyer for its gas at this point, which makes Turkmenistan extremely vulnerable and has absolutely no price leverage in any negotiations with China. I think we've also seen sort of the indicators of the economic effect of the declining gas export revenues, the reductions in public subsidies, the gas dispute with Iran, which is actually sort of shooting themselves in the foot by cutting off gas supplies to Iran to try to force the Iranians to pay their arrears for gas supplies that were essentially before Iran had the money from its unfrozen assets from the nuclear deal. Turkmenistan basically is turning the screws on the Iranians, and the Iranians have basically said, we actually don't need your gas that much. And I think this is the future issues that the Turkmen kind of overplayed their leverage. We have the line D, and there's a slowdown in growth in Chinese demand, or Chinese demand for Central Asian gas. And as we have Kazakh gas and the Uzbek gas that's also flowing to the pipeline, Turkmen are kind of out. They're still the greatest source of supply, and still 75% of the gas from Central Asia through the Central Asia-China pipeline is coming from Turkmenistan. But the growth, the overall growth in gas supplies to China is not as nearly as what Turkmenistan needs. And you basically see this, the TAPI pipeline, again, is sort of the more pipe dream than pipeline. We're still building it. It's basically a Potemkin village here, where we have a pipeline being built to the border for show, and with no realistic aspect of actually launching it into operation. The Trans-Caspian pipeline, again, we have the east-west pipeline. The dotted line here is now actually a completed pipeline. Whether there's actually any capacity or any willingness from the Turkmen to supply gas to the western direction, Trans-Caspian has to actually get a bilateral maritime deal between Azerbaijan and Turkmenistan on the border before any pipeline is actually going to be built. I would say the one area where we actually see some positives is in Uzbekistan. And I think the key question here, we had a transition in power, and surprisingly, actually, a reform-minded, the former prime minister, as now as president, has taken a much greater approach towards reform and opening up the country towards business, or making it more attractive. And I guess we basically start from a very low base here when we say it's an improvement. We do see sort of a more realistic approach from the government. Instead of emphasizing gas exports, is to look towards the domestic market to monetize its natural gas wealth. We have a dearth of liquids production and declining production, so we're shifting sort of the motor transport sector towards CNG to utilize some of the stranded gas. And we're also seeing some improvements in the actual natural gas, domestic gas production, or domestic gas market. 25 million people, it's actually a significant gas market on its own. And I think the government is now recognizing that if we actually can make better use of by essentially recycling some of the gas sector domestically, rather than looking to try to export gas to Russia, which does no longer want the same kind of volumes, even back from 2008. I think we have seen some positives on the reform agenda and liberalizing the currency reform, significant in terms of getting rid of what we've had, a duality in the SOM rate, the official rate, and the black market rate. And the official rate is now essentially in line with the black market rate. I think the bigger issues that we have, the bigger upstream investment issues, essentially we have, it's doubly landlocked, and it's surrounded by other gas producers who are competitors. So still, IOCs and foreign investors are much more focused on exporting gas rather than supplying the domestic market, and that's not going to go away. Ukraine, I think you can basically say that we've had the same stalemate issues. We have it's great possibility, but very little in the way of actual realizing the potential has been the bane of every Ukrainian government, post and pre-revolution. Quickly, I think the idea of getting to energy self-sufficiency is actually legitimate. It's just a question of the government's approach is all wrong. It's all theory and no actual reality. And there's a lot of things in their energy strategy to 2035 that actually are necessary to actually laying out a roadmap rather than a blueprint. And I think essentially getting past some of the recognition that Ukraine is seen as corrupt, it's seen as heavily administrative bureaucracy and regulatory burden is huge. Actually giving some incentives to investors to actually decide that they want to take advantage of some of the untapped conventional resources. So quickly here, one of the ways we look at this is to say we can quantify the above ground risk for upstream investors. Our oil and gas risk tool basically looks at 130 plus countries over 21 different risk factors and ranks them. So it allows you as an investor to basically say, I'm going to look at these, I can play with this to assess my own weightings. I'm going to just scroll through this quickly. The CIS countries obviously score poorly in some respects. If you go back to the overall, I pulled out the 5 big producers from the CIS to try to address or give you a sense of where these companies fit or countries fit on the overall upstream attractiveness index. What this is the 21 factors. There's methodology, there's commentary behind this. There's basically allows you to basically go back to your board to say this is the reason why we're investing in X country rather than Y. And just to quickly go over some, I know we're actually at end of time, but basically pulled out some individual scores, and you get a sense of where different the CIS producer countries rank. Obviously, government take and state NOC role is something where we have very negative in the overall sense for the CIS countries. Same with corruption, rule of law, and the regulatory burden, very much on the lower scale. I use the whole scale of 10 so you can get a sense of just how low each of these countries are. And then basically, if there's any other questions about this, I'm happy to address those in person. I'm happy to set up some individual trials if you're interested in seeing the interactive risk tool. I'll be available. I can't say how well I'll be able to talk, but I'm here for the rest of the day. So thank you very much.